Hey, welcome to another video here by the Tokyo Real Estate Man. And yeah, today is not going to be a balancing size of video, but it is kind of related to balancing. And that uh, I have recently, uh, with the sort of changes in the bond market over the last year and a half right now, I've always really looked at the 200-year interest rate chart, and you can find it here on any Google search. And it's might in some ways be one of the really best charts for you to look at over if you're into investing or saving money or seeking like a really good balance. Balance. No, balance meaning just like looking for the what I always talk about in my exercise and balancing videos is like looking for that economic sweet spot. So in terms of like your savings and stuff like that, you always want to find your point of maximum benefit in terms of risk and everything like this. And one of them is with the changing environment that's happened over the last year and a half, like the rates going from basically 0 to 6% on the payment side, and going from probably 3 to 8% on the mortgage responsibility side. So when you look at the 200-year, I kind of just did a little 200-year squiggly line like this, but then I thought here like this is a good way of really looking at the key point. Sort of key point in my estimation is really the 6% price for well, what is the bond, or the bond price is the price of money, and then the 8% and the 10% and the 0%. Okay, rarely on both ends of it, rarely if you look here, it was below 0% for basically 20 years, and this period here was the post-war period. So you can imagine that the governments were heavily in debt during that period. So right here, and it touched it recently, and this is the high, I guess, which be kind of coming into the sort of the mid 1980s. And I can remember I worked in the CIBC in 1987, and there was a couple that would come in and would get the interest from their savings account every month, and they had the investor savings account, and they would get like I would get paid $608 every 2 weeks then. And I can remember they had like 300,000 or something like that, and they'd get paid like $4,000 a month. I just couldn't believe it. They made. I was going to work at my shitty job every day, and I'd make $1,200 a month, and they were making $4,500 a month by just being at home. So, but that was at the peak right there, and then you see it after that. But coming back to the main point of it, it was over 8% in the last 200 years for about a total of 30 years, and it was above 6. And it sort of goes up and down, above 6 and below 6. And then what did I write here? And then you have like two other factors that are important: when it's above 6 in an uptrend, and then when it's below 6 or like near 6 but in a downtrend. Yeah, they tend to like go to like finish their trends. We don't know what's going to happen here because we're just below 6 right now, but the odds are that it might hit 6 and bounce down before it moves up, I would think anyways. So I just kind of wrote this here that if you're at a point you're above 6, and for example in uptrend, I think leverage or taking on debt is probably a bad idea. Okay, but depends on your circumstance. It depends on your personality, your risk tolerance, your like shakeability. And what I mean by shakeability is your ability to make it happen, or your will. Not only ability, your will to make it happen. Maybe you don't have that will. I used to have that will, but I have it a little less now. So, and everyone's going to be different like that. So, and here, cash, when it's above 6 in an uptrend, or above 6 in general, if it's in an uptrend, you might want to then also be like renewing shorter terms, and when it gets to that sort of point where it maximizes in the uptrend, that's when you want to lock in. Okay, but in when it's above six, your cash is in a so just for savings, like straight savings and like that, it's in a strong position. And then when it's below six, okay, your leverage, any especially when it's in a downtrend, leverage is good. Okay, so for example, when here when it was below six and in the downtrend like that, the leverage proved to be like a very good move. Okay, so like housing bears like Bill Ferguson, for example, uh, when it was he was always calling for like a housing correction, and he finally might be right now, but the conditions have changed because now the what you see is the interest rate rising, okay, in an uptrend, but when it was down in the downtrend, that's when leverage is good, okay, like both sides of the argument are good. Let's just come back to balancing, okay? And it's just like, what are we trying to do in our exercise? We're trying to find economic sweet spots in our exercise routines, right? That give us the most maximum return. And it's the same here when it comes to analyzing the bond market. When this was in a downtrend, Bill Ferguson was wrong, okay? But when it reversed here, Bill Ferguson is proving to be right now, and the real estate agents, right, are hoping for this downtrend. It might correct down to 4.5% and stay along there, and it might go up to 6, 7, and 8%. You don't know. We don't exactly know, but it's probably like looking at this chart right here. You see that it went up. It went up and down in these, but it rarely ends up at the zero. It was in the 0% for maybe a total of 20 years over the last 200. So the odds that it's going to go back down to zero again are almost, what is that? I guess 200 years, 20 years there. That's like, there's a 10% possibility. Yeah, but it rarely does it. You see, it was below here, and then there was what, like a 70 year, like a time frame of 70 years before it ever gets there again, and it was never in this zero position again in the last 200 years. Okay, so it happened here twice. It was in zero. Here's below zero, and it was never there before. So like when you hear I watched a couple of real estate videos, one by Jay Kupar yesterday, and then one by this other group this morning, and they're kind of been saying that, hoping that rates are going to come down again, but the odds of that happening are pretty slim. Okay, so you have to. This is a really useful. This might be one of the best for the savings, or like from a strategic point of view. This 200 year interest rate chart might be and might be the most useful chart for you to study if you're like a balancer or investor. Balancing is just the way that I sort of have an outlook on the entire world and stuff like that, and it's reflected also in here. But again, the important part is like the sort of key point of the interest rate seems to be the 6%. Okay, and then when it's above six, it's going to hover around that sort of point, and it's going to be manipulated sometimes. I I uh, I sometimes think that there's like, I'm going to make some other videos, but like people seem like to talk about the inflation, the high interest rates are like a way to offset inflation, but that is just one sort of reason that maybe interest rates are up. There are other factors involved in that. Could be, you'll see that other people, like when you dive into the interest rate world, you'll see that there's other like important factors that might be there. For example, is the analyst Tom Luongo, who talks about the interest rates being pushed up right now, is a bit of a war between the Federal Reserve and the European Central Bank. And the European Central Bank, Tom Luongo's point is the European Central Bank wants, because they don't have access to oil and stuff, they want like these negative interest rates because it allows them to print money and get access to, like, for example, the American continent has more oil on it and the European continent has no oil. So they want to keep these interest rates low so that their power is higher because they don't have any like physical resources. And then it's a really interesting model because that is probably one of the biggest impetus for like European discovery, probably from the from the 14th century with like Columbus and stuff like that, is finding itself repeating. Europe's sort of lack of resources pushes them out to the world to go get further resources. And yeah, that's the kind of like so that the interest rates manipulation between the two central banks and the Japanese central bank, and at this point in time, according to Luongo, is sort of a power struggle right now. Anyhow, there's other kind of, Catherine Austin Fitz has a different take on that as well. But yeah, it would be good for any person to sort of jump into this interest rate, 200-year interest rate chart to study it. Very, very good for you. Like there are things like Tom Luongo's point or Catherine Austin Fitz's point, but like ultimately we're just small people, right? And we're like, I'm the leader of my family, right? And I just try to make good news for our family, right? And I'm interested in trying to find out what the sweet spot is like for our family's sort of returns in the bond market. And this was a really good way of analyzing it. And I'm going to make some more and more videos on this going forward. And yeah, it's also a very subject I was very interested in right from my working at the CIBC, which is I used to work on Granville Street here in Vancouver from the age of 18. And when I would look at the savings returns of that particularly that elderly couple who was bringing in, I think, $4,500 a month, which was, I guess, I was bringing in $1,200, so they were making 4 times my income as a worker in interest payments in the mid 1980s, and that had sort of pushed me into this. I was interested in those numbers right from that very age, so in 1987, straightforward to now. And then I didn't have access to any of these sort of charts, and I think it's a very good one. So if you have a chance, everyone, have a look at the 200-year history of the bond charts or the bond rate chart, and it's very, very useful. Okay, another real estate video. It kind of is real estate, but another video by the Tokyo Real Estate Man or the Balansizer. Cool. Thank you very much.